Good evening. Another night, another day, another afternoon. Ready for the today's tax talk. Today we're going to talk about the Olympics and the IRS. Think about it. Nothing gets past the IRS, and not when you're winning money. That's a gift, or that's a reward, and you're going to pay on it. So, but there's been some changes. So we're going to talk about that right here on the today's tax talk. Thanks so much for joining us. I appreciate you taking the time. Again, as we talk about the Olympic gold, what is that? I remember a couple of years ago during the last Olympics, I did a story on this, and I was kind of surprised at how much the people had to pay from the gold when they won a gold medal to the IRS. How much of it went to the IRS? But because of the outrage the last time, because they got a lot of press the last time, there has been some changes. So first I'm going to read a story, or review a story. I won't read the whole story, but we'll review the story from a couple of years ago and what they were paying then, and then the story now. I'm also going to talk a little bit about the opportunity zones. That's something that I took a lot of interest with when it was coming out. I did a lot of research, went to some conferences, seminars, did a lot of reading, thought it was a great idea, but suspected that the government wouldn't follow through. And maybe I was right, but that's something that we're going to find out. So let's first talk about the Olympics and the cost of Olympic gold. So this is an older story. As the world is stuck in the Olympic fever, let's go back. Skip. First, you may be surprised to know that the value of a gold medal is only $600 because it's not gold. It's mostly silver. It's covered with gold. That's gross earning. And that back in the last one, I think it was 2016, that there was gross $25,600 was the gross earnings of a gold medal, and that's what they would get. And then they would hit them. Now, obviously, once you win the gold, you also get a lot of money for endorsements and such, and personal appearances and such, and all of that is taxable as income. And so that so your tax troubles once you win the gold are just beginning. But again, if you're winning $25,600, much of that would go to the IRS until this change. And so a first-time gold medalist's life is almost certain to change big time after a monumental win. Along with the recognition and medals comes cash prize money and endorsement deals. But aside from perhaps hiring a public relations team or a manager to keep up their appearances and deals, many athletes should also consider getting a wealth advisor or estate planner because they win big. So does the Internal Revenue Service. Again, whenever anybody makes a lot of money, you're going to be paying the IRS. Okay. In addition to the medals awarded by the Olympic Committee, athletes get $37,500 this time for gold, $22,500 for a silver, $15,000 for a bronze. Historically, prize money and the value of any medal awarded were treated as income for the federal tax purposes under Section 74 of the Internal Revenue Code. However, following the 2016 Olympics, the Obama administration decided that it wasn't fair to penalize athletes who make personal sacrifices to train and represent the United States on a global stage. My own opinion is it's not fair to really tax the people. Anybody who goes into business for themselves, does a lot of personal sacrifice. It puts a lot of their own time and efforts in, but we don't reward them by lowering their tax burden. But I digress. As a result, Congress passed H.R. 5946, which amended 74 to make a distinction for those athletes with more modest financial success. So those who are still successful, and I think they mentioned in here people like Kevin Durant, right? He's making a ton of money. He gets taxed on it. They don't give him any break on it. While those athletes who earn more than $1 million in income after deductions are still subject to the so-called victory tax at the top marginal rate of 37%, those that earn less than the threshold amount are now spared the tax. So while someone of Simone Biles' stature, who potentially rakes in millions in appearances and endorsements, or Kevin Durant's, who paid $1 million by the Brooklyn Nets, will likely owe thousands in taxes for their medal wins. A first-time Olympic gold medalist such as pole vaulter Katie may potentially owe nothing. Worth noting is that Olympic athletes and typically most of their international athletic event participants don't face any international cross-border taxation. That surprises me. I know they were in Los Angeles. I think probably Los Angeles was trying to tax them all. They don't want to get them out of California without paying tax. I think probably New York and Lake Placid years ago too. I don't know if that's true, but that's what I'm guessing. But according to this, they don't pay that. Don't face any international cross-border taxation, as host countries typically have a special tax treatment in place for prize awards for non-resident athletes. And though some countries, such as Singapore, require athletes to donate a portion of their winnings to charity, transferring Olympic prize money directly to charity in the United States won't save an athlete on taxes. According to Section 74, prizes and awards are only excluded from gross income if the recipient was selected without any action on his part to enter a contest or proceeding. The tax consequences of regifting any prize money get murky under the International Internal Revenue Code, as does writing off travel, training, and other expenses leading up to the Olympic Games. Even those athletes spared the victory tax will likely end up needing professional tax advice to tread water as endorsements and other opportunities flood in. Well, true enough. Anytime someone gets into some money, you should probably get some tax advice, right? So we offer tax planning to people. We also battle the IRS if you owe any money, but we also help people avoid owing any money. One of the first things you should do, we've been helping a lot of investors, and one of the first things you should do is try to lower your tax burden legally. Nothing wrong with that. You're not avoiding taxes. You're reducing your tax burden. Again, legally, nothing wrong with that. Use the code, the IRS code, in order to pay as little taxes as you legally can. And there's lots of ways to do that. Okay, so, and I don't think a lot of people really realize that, how many ways there are to reduce your tax burden just by being active and participant and getting the right advice, right? So I think it's very important. We try to provide that to people. We want to give people the right advice on how to reduce their tax burden. One of the things that we help a lot of our clients do, because a lot of our clients are small business people. And what we do is we help them come up with a business structure that makes sense, right? That will lower their tax obligations. So I always tell people, who pays the most in taxes in our society? Small business people, sole proprietors, because they wind up paying self-employment tax and income tax on 100% of their income. Well, you don't have to do that. There's ways around that. Again, you're not avoiding taxes. You're just changing the structure so there's a different tax consequence as a result. And again, there's nothing wrong with that. There's nothing illegal about it, and there's nothing nefarious about it. So I would say, and there's nothing. You can always overpay your taxes if you want to, but most people don't. You don't want to pay more than you have to. And I can use the term of the day: pay your fair share. Well, doesn't the tax code tell us what our fair share is? Isn't that what we're supposed to do? Or are we supposed to follow the tax code and then give them a tip on top of that? I don't think so, right? My fair share is what I'm legally obligated to pay. That's my fair share. And so I think a lot of people pay more than their fair share. And so you shouldn't pay more than your fair share. Pay your fair share. And that means getting involved, getting professionals to help you with tax advice, tax planning, business structures, things like that. Again, nothing wrong with that. You should do that. The next, I'm going to talk about one more story here. And I'm going to talk about it because I have talked about this. I've been following this since the beginning when they came out with the Opportunity Zone. I think it's a great idea. I think that a lot of, focusing resources in the low-income areas makes sense. right? And how are you going to do that? Well, you have to give some kind of tax incentive, because if without tax incentives, there's no reason to invest there. It's too risky. And so one way to reduce the risk is to lower the tax burden, right? So if I lower the risk by reducing the tax burden, more money can flow into that segment, and everybody benefits. And so that's what the opportunity zone was all about. But what's happening now is the IRS, let me go back to the title here. IRS takes scalpel to opportunity zone regs in new update. Okay. Again, what's the problem with the opportunity zone, and this has always been the problem with the opportunity zone, is that the regulations were always they were never really set. And even after they passed the law, the IRS hadn't come out with its rulings about how they were going to apply it. And so that kept changing. And, when you're talking about investing millions of dollars into a high risk area, as we just discussed, I want to be able to be confident that the rules are not going to change, because once I am committed, especially many of these opportunity zone investments include real estate. So you have to go in and buy real estate and then take the time and the money to build on that real estate. And that's where the problem comes in. And that after I've already spent all this money and I have all of this commitment into these areas, only then the IRS comes in and changes the rules. Now, they say they're not. They're clarifying the rules. But the clarification never helps the investor. It always helps the IRS, and they're trying to limit who actually can get these tax deductions, or actually you don't pay any tax. You can waive much of your of this surplus, right? And so, again, a lot of times I think that's what's happening now, that they don't want people to avoid paying capital gains tax, and that's what the opportunity zone was. Well, it was a way to encourage people who had whose assets had grown to sell those assets and then use the money in the opportunity zone, right? In the United States, you are only taxed when you sell the asset. You are not taxed while you hold it. So many times people don't want to sell the asset and realize the capital gain. Rather, they just hold on to it, and that way they're not taxed. And so the opportunity zone was an incentive for people to sell assets and reinvest that money in a different area that would be more beneficial to everybody, and including the investor, because they would avoid capital gains taxes. And that's what this whole point was. And if you were involved in the opportunity zone and you kept your money in there for 10 years, you would avoid capital gains tax altogether. If you left it in for less than 10 years, then you would just delay the tax. And sometimes, there's value there. Obviously, there's a time value of money, and delaying a tax is a benefit. But the real benefit came with buying and holding for at least 10 years. So I wanted to mention that, because I think this is another, underhanded way the IRS works, that they start redefining things and clarifying things and taking away much of the benefit that people realized from it. So anyway, that's my stories today. I appreciate you spending some time with me here. Let me get into this, because I wanted to I want to ask you again to share, like, subscribe. Okay, so if you're subscribed, put something in the comments. Tell me that you subscribed. This is who else is giving you tax information every day of the week? I am. I think I'm the only one doing it. So, share it with your friends. Share it with those who need this information. Share it with everybody. Subscribe so you can get this information every day, and hit the notification button so you get notified whenever I am going live. Okay. One more thing, you can get a copy of my book, Deal with Your IRS Problem Today. Go to freeirsbook.com. freeirsbook.com. Get a free copy of my book, Deal with Your IRS Problem Today. If you're fighting an IRS problem, you'll get some answers in that book. So thanks so much for joining us here today. I look forward to seeing you again next week. Now, remember, on Fridays, I always do the Watch Talk Radio when I record my 2 radio shows, the IRS Radio Hour and the Trust Radio Network. We record them on Friday afternoons at around 2 o'clock. Then you can join us live then. We stream both of those. So, again, thanks so much for joining us. I appreciate you taking time to spend with us today. And we'll see you again next Monday. Thank you.